Hello and welcome to this week's weekly financial update from RTS Financial Planning. Hope you're all well as we come to the end of lockdown 2. So currently we're filming this on Thursday the 26th of November and we're waiting to hear what tiers our regions are going to be put into. And I feel it's a bit like waiting for your exam results and if you're going to get into the university you wanted to. But I hope it all goes well for you. So as always, it feels like a bit of a busy show this week, but we'll start with the weekly stock market performance. And again, it's been a pretty good week for the stock markets, with all of them really recording positive results. And there's been a lot of positive news to help encourage investors' confidence. So more news on, good news on the vaccines. So the Oxford AstraZeneca vaccine looks like that's going to be pretty effective as well as the others. And also, finally, it appears that Donald Trump is coming around to the idea of conceding defeat to Joe Biden in the US election. So he's now allowed the presidential transition team to start working with Joe Biden's team to help Joe Biden start to take office. So he's not formally agreed or conceded defeat in the election, Donald Trump, but it does appear that he's moving that way. And again, this gives investors confidence because they feel that they know what's going to happen next and that Joe Biden will start to become US president in the short term. But it was a week for record highs in the investment world. So starting off with the Dow Jones Industrial Index. So this is one of the major stock market indexes used in the US and around the world. And this hit 30,000 points for the first time in its history. And again, because of all the positive news that's been recently, so US stock markets continue to rise. Also, another investment that was very close to hitting its record high, and it may well have done so by the time this recording is finished, is Bitcoin. So some of you may be aware of what Bitcoin is, and some of you might not. But one Bitcoin is now worth around $19,000, which is touching its record high from a few years ago. So just a quick note on Bitcoin. If you're not aware of what it is, it's what's called a cryptocurrency. So a cryptocurrency is something that has been created pretty much online by computers. And it's a currency, but it's decentralized, meaning there's no one central bank or government in control of it, which can set and manipulate prices. And some investors like this. They like the fact that it can't really be manipulated because it's decentralized. And investors have been piling into Bitcoin this year. It's up over 100% for the year. But I will say it's still very new. It's a very speculative asset. And I would not advise investing in it unless you are clear and know what you're doing. Remember the old rule, don't invest in something you don't understand. Okay, so that's just a quick note on Bitcoin. So the big event this week was the government's spending review, as announced by the Chancellor yesterday. So the spending review is a bit different to the budget. So in the spending review, there's no sort of policies on tax or tax changes announced. It's more a case of what amount of money is being allocated to each government department that they can then spend. But we did find some interesting facts on how the UK economy is doing, and as expected, it's not doing great. So borrowing this year is expected to be £400 billion. So the government is looking to borrow £400 billion this year, which is the most in our peacetime history. And the economy itself is expected to be around 11% smaller than it was this time last year. So a lot of recovering to do. There's one interesting fact, slightly sad fact, that we found out yesterday, where the government is actually saving £600 million this year by paying less out in state pension payments. And the reason it's paying less is because there's been a lot higher number of excess deaths than usual, which is particularly hitting state pensioners. So a number of state pensioners have died, which is saving the government £600 million in state pension payments. So that's quite a sad fact there. The most interesting piece to come out of the spending review, which probably not been covered by the main news outlets, has been around the government's measurement of inflation. So just to give you a bit of history, back before 2013, the official measurement of inflation was the Retail Price Index, or RPI. But in 2013, the government scrapped this and changed it to the Consumer Price Index, or CPI. But interestingly, they kept RPI for a few things. So if you're an investor in government gilts or got loans to the government, you probably wouldn't be directly, but your pension funds probably are. Then there are things called index-linked gilts, which are gilts that pay you an interest linked to inflation. So the interest payment will go up every year if inflation goes up. So these index-linked gilts have maintained a link to RPI rather than CPI. Also, train fares, rail fares, they usually go up by RPI every year rather than CPI. And the reason why this is all interesting is because RPI is usually slightly higher in percentage terms than CPI. And it can be anything from around 0.5 to 1% higher each year. And the reason why that's interesting is because the government are planning to scrap RPI altogether in 2030 and replace it with the Consumer Price Index, including housing costs. So this becomes CPI-H. Stick with me here. So RPI still also applies to a lot of pensions and payments. So if you've got a defined benefit pension or a pension annuity, it's likely that your pension payments will increase by RPI each year. So it gives you an increase in income every year to keep in pace with rising prices. But by moving RPI to CPI-H, it means that your pension increases in the future are going to be slightly less. And the Daily Mail did an example of this. So I'll just nab this from the Daily Mail. They worked out that a person with a £20,000 per annum pension income could lose around £119,000 over the course of a 30-year retirement if RPI is changed to CPI-H. And that's using RPI at 2.8% and CPI-H at 2%. So 0.8% difference. That 0.8% difference over 30 years could mean a huge loss in pension income. So it's a big change on the way. So it's important you are fully aware of this and how it's going to impact your retirement income. Which leads me on to a more closer look at defined benefit pensions altogether, because this will have a major impact on defined benefit pensions. So just to recap, defined benefit pensions are also known as final salary pensions, and in the past they've been known as a gold-plated pension scheme, because these pension schemes guarantee to pay you a level of income for the rest of your life. But in recent years, due to the changes with personal pensions, so defined contribution pensions, the pensions that you probably have with your workplace now, they've become a lot more flexible in the way you can access them. So it's made defined benefit pensions perhaps not as valuable as they once were seen. And what this goes to show is that actually you should definitely consider reviewing a defined benefit pension. I'll give you a couple of reasons why. So with a defined benefit pension, it's great. It pays you a guaranteed income for the rest of your life. So you've got no worries about the stock market and no worries about living longer than expected because your pension will continue to pay you an income. Although with these changes to RPI to CPI-H, that income is not going to rise as fast as it once was promised to. But on your death, the pension income that you were being paid will reduce probably by around a half and be paid to your spouse. So if you've got no spouse, then it's likely that your pension will stop altogether. There'll be nothing left. But if you do have a spouse, then it's probably your spouse will start to receive half the income you were paying. So a 50% loss at that stage. On the death of your spouse, your pension will stop completely. There'll be nothing to be paid out to your children. So 100%, guaranteed 100% loss on second death. If we look at the alternative, a personal pension, private pension, it's a pot of cash. There's no guaranteed income for your retirement, but what you can take out will depend on how big your pot size is. So you can take out as much as you want, whenever you want. So there's much more flexibility there. So on your death, whatever's left in a pot is left for your spouse. On your spouse's death, whatever's left in a pot is left for your children. So this could go down generations if the pension is managed correctly. Now, if you've got a defined benefit pension, it is not set in stone that that is the pension you have to choose. It's highly likely that your pension scheme will offer you a cash equivalent transfer value if requested. And it's that value that you can then transfer to a personal private pension and then benefit from the flexibility. So why do you want to consider a transfer and who's it mainly appeal to? So if you are married and you have children, perhaps you've already got a defined benefit pension, so you've got more than one defined benefit pension. So if one covers all of your essential spending, then you might want to consider having the other one transferred so you've got more flexibility, so you've got the best of both worlds. If you want more flexibility in your income, so with a defined benefit pension, you've got a guaranteed income for life, but it's a set amount of income each year. There's no way of tweaking the levers. You can't have more in one year and less in another. With a private pension, you take out from the pot what you want. So if you want to spend more in one particular year and less in another, you can do that. So yeah, now's the time. I'm not saying that a transfer is right for everyone, and I definitely wouldn't advise, this is not advice to transfer your defined benefit pension. But what I am saying is that if you're in this situation, you might want to consider reviewing it, particularly with the announcements to the changes in the way it's going to be increasing going forward. Now, this applies mainly to defined benefit pensioners in the private sector, because you can't usually transfer a public sector defined benefit pension. So yeah, private sector defined benefit pensions that are usually deferred. So that means that the scheme is sort of closed to further accrual, or you've left the company. That means it's now a deferred pension. Yeah, and if you're married with children, you're comfortable with investment risk, you want more flexibility, then you're definitely the sort of person that should consider reviewing your defined benefit pension. Okay, that wraps it up for this week. I hope you found it useful. As always, please leave a comment if you've got any questions or any bits of financial news that you found interesting you feel our watchers may appreciate. But until next time, I hope you get the tier you wanted. But until next time, take care.